This is TreppWire Week in Review for the week ending November 24th, 2023. I'm Haley Kuhn with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. And welcome to an early Thanksgiving episode of the TreppWire Podcast. The markets have been quiet this week, with a few deals getting done and very little in the way of new macro data. However, there were a lot of retailers posting earnings, and there were lots of concerns there. Manus, are you going into the holiday glass half full or glass half empty?
Well, it was a very funny week in the sense that we came into the week with an awful lot of momentum. Stocks have been really surging, helped by lower interest rates. We've seen a resurgence of the AI optimism, which has driven tech stocks higher over the last couple of days. So coming into the week, we felt great. There was a lot of talk about the Fed having ample ammunition to not be as hawkish going forward. People were talking about rate cuts in 2024. All that was driving a lot of optimism on the part of money managers, retail investors, just mom and pops looking at their 401ks. It had felt good. There wasn't a lot of macroeconomic data this week, Haley, as you mentioned. There wasn't a CPI or a PPI number to look at and kind of digest. So what we were left with was a bevy of retail earnings this week, and a lot today. We're recording early. This is Tuesday, November 21st. A lot of earnings came in, and they were in stark contrast to all of the optimism that we started the week with. And what we found is that while Wall Street and people with 401ks and borrowers were feeling quite upbeat over the last 2 weeks compared to where they were a month ago, retailers were kind of playing a different tune. There were some exceptions this week. Dick's raised their forecast. That was a positive out there. Abercrombie and Fitch had nice earnings. They did pretty well. So there were some outliers there. But by and large, there were many more warning signs coming from the mouths of CEOs than there were bright spots. So if you run down the litany of what we saw today, Best Buy, concerned about the holidays, Lowe's, home improvement, sales down, Nordstrom, disappointing sales, Kohl's, disappointing sales. So when you take it on the sum, what you see is a situation where all these retailers who are really the boots on the ground, when you're talking about seeing how the economy is flowing, the ones that came out this week, along with Target and Walmart last week, are all kind of putting up the warning flare to say, it's not as good as you think it is out there.
Yeah, I think the question then, Manus, is just, is it a tired consumer? Is it a spent consumer? Is it just people beat down from all of the inflationary pressure and talk that we've seen over the last 15 to 18 months? I mean, I think that's the part of the equation that people are trying to figure out on the go forward. You know, this concept of transitory inflation has been proven, that it was more than that, but the consumer has been incredibly resilient up until recently, where we're starting to see some blips in some of the earnings. And I read a lot of stuff over the last couple of weeks where people are estimating there's going to be a lot of gift card sales over the holidays this year, because the consensus seems to be that inventory will be plentiful after a tight consumer spending holiday season, and you'll be able to scoop up a lot of goods at a discount price after the holiday season. So it'll be interesting to see how those things actually play out. The Fed minutes came out today from the meeting earlier this last month, and it was kind of a couple of takeaways there. It seemed like there was a unanimous feeling that monetary policy must remain restrictive. So I know you had said, there's maybe a less hawkish tone, but I think there's more of kind of like a broken record tone in the sentiment here of the 2% target is still what they're aiming for. Inflation is down, but it's not where they want it to be. There's no indication of any type of near-term cuts from the Fed minutes. So, we'll see how that plays itself out. I thought a couple of other interesting things that you mentioned, Best Buy as one example. I don't know if you've been in a Best Buy store lately, but I don't know how they're making it. I mean, like, I've gone to a Best Buy a few times to get a few things for the kids, and it's just it's like a ghost town. There's not much help there. They have not a lot of inventory on the shelves, and with all the downward pressure that they're facing, I think a lot of these retailers, even though we've been very bullish on retail generally, I think a lot of these retailers like Best Buy are still in a somewhat antiquated business model that may not survive this.
Yeah, there's a lot to unravel in your remarks there. Let me take them one after another. On the Fed side, I am certainly not in the camp of some who think we're going to see 4 rate cuts next year. I believe the Fed. We saw the Cleveland Fed president, I believe, this week say we definitely have to be higher for longer. They've been parroting that endlessly for the last year, higher for longer. We need to squeeze out inflation and so forth. So it would not shock me if we didn't see our first rate cut until very late next year, absent some kind of exogenous event, some kind of global unrest or some kind of shock to the market. I'm not in that 4 rate cut side of things. On the retail side, back to your question, Haley, am I glass half empty? I do have to say this retail news kind of took me by surprise and made me a little concerned. You know, when you hear 1 or 2, Walmart or Target, they're enormous, and certainly they're going to outweigh the voices of others. You say, okay, they're seeing some softening, and maybe I'm a little bit concerned. But when you rattle off so many of the other ones that came out today, which is a broad swath of the market, right? It's Target and Walmart, Middle America, Best Buy in the tech space, Kohl's, the apparel space. And by the way, I did leave out one winner today, Burlington, a huge winner today, up 20%. So they joined Dick's and Abercrombie and Fitch as some of the winners. But I have to say that it did put me on my heels a little bit. I had come to the conclusion, at least, that the worst was behind us. We had hit peak rates. The peak rates didn't come with a 4.5 or 5 handle on unemployment. We were seeing commercial real estate activity continued to take place. The markets hadn't completely seized up. The bank failures didn't extend beyond the 3 that we saw in the spring. So I was becoming very cautiously optimistic. I think this kind of set me back. And maybe, Lonnie, you can comment on this. I guess part of my optimism was the thought that, you know, gas prices are down a good 40% from their peak. And rents have clearly leveled off. We're not in this hyperinflation of multifamily rents anymore. And I thought, if anything else, that should be giving the consumer a little bit more confidence. And it doesn't appear to be that way.
Yeah, I agree with you. I think I was in the same camp. I think the reality, though, of people maybe living beyond their means during the last 4 or 5 years is really starting to catch up with them. So even though gas prices are down, even though the rents are down or flat, those credit card bills are still coming due. Those really high car payments are still coming due. I mean, there's just some additional pressures that are being felt. You know, I think Lowe's was an interesting one too. Lowe's was down, and they've been kind of pretty steadfast growth and optimism during COVID, the lockdown and everything else. It's almost like some of these retailers are feeling a little bit of the Peloton effect. You know, some of that benefit or bump that they got in e-commerce or other type of sales during the pandemic have finally worn off, and they're starting to see a little bit of a retrenchment. So, you know, I'm with you. I think if you had asked me, I would have said that the worst is behind us. I think sometimes, though, we're maybe a little too quick to look at the rosy data. And the reality is there's probably a lot more people in that middle to bottom tier of the socioeconomic spectrum that really are getting hammered. And gas prices are a nice reprieve, but it doesn't really move the needle for them in terms of the overall picture.
Yeah, and I also wonder how much of inventory was pulled forward from people during COVID, right? That, you know, you heard that YOLO expression over and over and over again, people wanting to spend money, pent up demand for things. And when you couldn't go anywhere, this idea of getting that Peloton or, you know, buying an Alexa or getting some kind of new gadget or something like that. And I just wonder if part of this is just so much was pulled forward during the COVID time that absent restaurant and travel, that people have spent their money. They've gotten the little gadgets that they want, and there's nothing that they need at this point. And maybe that's part of the narrative as well. But I'm far from a retail expert. It's a shame. We did a great podcast recently with Carmen Spinoso, who's a receiver, for many shopping malls. He probably knows the mall space better than anybody in America, quite honestly. And it was a terrific podcast, I have to say. If you haven't listened to it, you should check it out. But it would have been great to have had this data before that podcast. Maybe we'll have to have him back in and have him weigh in on the where the consumer resides right now in terms of his or her confidence.
Agreed.
So let's stick on the theme of retail. We have a few stories there this week, and we also saw some retail property sales as well.
Let me start with the positive story here. There's two of them, two sales. You don't see a lot of sales during the week of Thanksgiving. The markets tend to dry up. But we did see two this week, which I'm happy to report on. The first one, this comes from a press release. DLC Management and DRA Advisors have acquired 4 retail centers for $100 million. The properties are located in Colorado, New Jersey, Arizona, and Ohio. It looks like the average size of these things is probably about 250,000 square feet. It contains the types of tenants that we've talked about often over the last 2 years as being highly desirable and strong performers. So tenants like Target, Marshalls, Home Goods, Trader Joe's, Michael's, are among the tenants in this property. So the takeaway from this sale is that, like I say every week, you spend $100 million on something, you've done a lot of due diligence, and it's a sign of confidence. And anytime we can report on that, we are happy to do so. Another sale this week, Site Centers, who has been an active seller. I believe they're moving more into open air, if I'm not mistaken, but they sold the West Bay Plaza in Westlake, Ohio for $42 million. That story comes from Crane's Cleveland Business. The sale price amounts to $270 a square foot. The property is a $150K asset on Detroit Road in Westlake. A Fresh and Time grocery store is the anchor. Other tenants include Ulta Beauty, a Chase Bank, and Chipotle. So those are our two sales. The two crabgrasses that we have, well, one's crabgrass and one's good. Let me give you the other good one. In this case, the story, the subject property is the Westfield Countryside Mall. This is in Florida, Clearwater, Florida. Our listeners will know that Westfield several years ago said that they wanted to be out of the mall space. They wanted to sell their 30 plus malls in the US. This was one that they said that they would no longer support the asset going forward. A receiver was put in place, and the mall has been in purgatory ever since. It hasn't gone REO yet, but Westfield has basically given up the ghost on this. The collateral was valued at $270 million in 2013. The value bottomed out at $92 million in 2020. But since then, surprisingly, the value has been upped 4 times, and that includes this month. The value now this month goes from 108 million to 116 million, which is part of our narrative for the last couple of months, that there are some green shoots. I mean, certainly this is still sizable negative equity, still about 22 million in negative equity on this particular asset, but that's down from what had been about 55 million in negative equity a couple of years ago. So a green shoot in that Florida mall. And the one piece of crabgrass we have, this is the Southridge Mall in Greendale, Wisconsin. This was another case where the borrower had indicated they were willing to give back the property to the lender via friendly foreclosure. This property was valued at 181 million in 2013. This month, the value of the collateral was lowered to just 41 million. So this property backs a $104 million loan, which now has about $60 million in negative equity. So tough sledding for that Southridge Mall in Wisconsin.
Yeah, so that's a lot of retail ground that we covered there. I want to circle back to a couple of these. On the DLC DRA acquisition, I think you hit the nail on the head, man. It's this tenant composition of Target, Marshalls, Home Goods, Nike, Ulta Beauty. Those seem to be the really preferred tenant mix for investors at this point. So we've talked about a number of retail sales over the last couple of months, and it seems like Home Goods, Marshalls, Target seem to be a repetitive component of each of those sales. So it's really great to see that they finally figured out, the composition of what makes a good center, and people are transacting on that. The Site Centers, again, another great sale, about $270 a square foot on that one. And then on the Westfield Countryside Mall, you had talked about the collateral value and that going up some. But just for some reference for the listeners, for the first half of 23, the loan had DSCR at the net cash flow of 1.08x, and occupancy on that asset was around 72%. So this mall, while it's seeing a slight uptick in valuation, is still operating at a significantly less than stabilized occupancy at 72%. So hopefully they're able to get that turned around, and who knows, maybe one day Carmen Spinoso and his team might come in there and lease that sucker up.
Yeah, the retail space, I consider myself knowledgeable about CRE finance, and I'm not as knowledgeable as Carmen Spinoso and some of the big Manhattan office developers, but I feel like I know a fair amount about commercial real estate. But there are some things that just you look at and you say, wow, I just did not see that coming. I've talked about this before, student housing. I thought this idea of people paying for their kids to stay in student housing, yet not going to class. If you said that student housing would stay in the 90% and above occupancy, I would have said you were crazy in 2020. If you told me that same year that a shopping center with a Marshall's, a Joann's, or a Michael's, a Petco, and a few other things those were going to be your stars. I've been into a Joann's, right? How many knitting needles do you need? It's unbelievable. Yet those things, or Michael's, same thing, right? These craft stores. I just look back and I think if I had been a money manager, I would have been shorting these things right and left. I would have lost my shorts.
Yeah, it's really interesting how they've come out on the backside of that. To your point, I mean, some of these things, there's no way I would have taken the short position on every one of those. And they've come out, and now we're at 2023 year end. And, the narrative is not just that they survive, but really they're kind of the preferred composition, preferred asset class. And, you're really starting to see retail. I've seen a lot of chatter on social media the last couple of weeks about, retail rents being pushed and everything else, and occupancy reaching all-time highs. And so it's kind of a narrative that probably hasn't gotten enough love. I know we've talked about the retail renaissance over the last couple of months, but on the broad scale, I think people still have a negative connotation about retail from the previous 5 or 6 years. And the reality is that asset class has really repositioned itself very well.
Let's shift gears to our office segment. We have a lot of stories to cover there today.
Yes, we had a lot of office stories this week. Hopefully, I've organized them in a way that makes a little bit of sense. I'm kind of all over the place as I prepare to make my ambrosia. If you heard our last podcast, I had to get all my ingredients. So some travel involved in my life this week. And we're recording late on Tuesday, so everything's moving sideways from our normal routine. So hopefully, Haley and Lana, you could bear with me as I run through these things. These were some headlines we came up with from either scanning the news or in most cases from our Trepp data that we acquire from trustees and servicers each month as CMBS deals roll. The first one was a trading alert that we put out a couple of days ago. A $64 million portfolio of offices in Midland, Texas appears like it will be going back to the lenders. The loan is backed by 5 office properties in Midland. The largest is the Bank of America Tower there. In total, the portfolio contains about 700,000 square feet. And even though it's going back to the lender, or at least that's the original indication from the borrower, it comes as quite a surprise. For H1 2023, DSCR was 1.62x and occupancy was 73%. So this is a case where lots of leases are coming due between 2023 and 2026. And if this stays on the trajectory, it's a case of a borrower throwing in the towel very, very early. We know sometimes these transfers and these indications can be an effort to squeeze out some leverage out of a special servicer. So it's never the final word, but it is something to watch. In Colorado, this is something we covered a few weeks ago. We noted that Burns and McDonald had opened up an Englewood, Colorado office, and that they would be moving out of 2 different spaces elsewhere in Englewood, Colorado. One was the Meriden One Colorado office on Maroon Circle in that town. That particular asset saw its valuation cut by 75%. Burns and McDonald is a defense contracting firm. They were the sole tenant in this building. The property there had been valued at $24 million in 2019. Now that B&M is gone, the value of that property has been lowered to just $6 million. In Dallas, another Texas story, According to new special servicer notes, the borrower behind Preston Plaza in Dallas will no longer fund operating shortfalls. This loan has been transferred to special servicing. The collateral is a 260K square foot office on Preston Road in that town. DSCR has been below 1.0x since 2021, and leases for the top two tenants expire next year.
So let's talk about the Midland office portfolio first, Manus. That one doesn't come as a huge surprise in the sense that Midland is kind of a boomer bust city. So you have like Midland, Odessa, the Permian Basin. They've been in good times. There's more private jets flying in and out of there when the oil markets are strong. In the downturns, sometimes you can't give stuff away just because people aren't as attracted to that area. So in this case, the financials look really strong on it, as you mentioned, but they do have a lot of expiring leases, and occupancy across the portfolio is not great. And just generally with the office headwinds that we're seeing, on the macro, I could imagine Midland feeling some, increased pressure there. So that one, I think is maybe more just external economic obsolescence or some impacts that market's feeling. But I wouldn't hold my breath. Like if the market turns, oil goes back up, things start to pick up here in the Permian Basin, like that market will come back. They've gone through a number of cycles. It's very similar to the Houston market. And then the Dallas story on Preston Road. Preston Road is a nice location. This is a nice building. So this one here is a little bit interesting for me. This makes me think that there's probably just some functional obsolescence in this building relative to some of the newer stock in that marketplace. And so we'll see what happens. But I think generally in that area, there's a lot of high-end retail. There's a lot of other high-end consumer shops. And so hopefully somebody can get this at a reset basis if they end up taking it through the process and revitalize this building.
So when you say high-end, Lonnie, is it your high-end? Like, is it Gucci or is it my high-end? Like Five Below?
Yeah, it's way higher end than where I would shop. But yeah, so like Preston has some nice jewelry stores. It's got some really cool, trendy retail establishments, and so it's one of those things where I generally drive by, smile, but I don't stop and partake in purchasing anything.
So I'll go through one more crabgrass story, and then I do have some green shoots. This next one comes from The Real Deal. Deutsche Bank is looking to sell 222 Broadway in Lower Manhattan. The report says that the property could go for $150 million to $200 million. A $200 million price would equate to about $256 a square foot. If a sale happens, and this could be one of those office to residential type deals, it would mean a really hefty loss for Deutsche Bank. The property is a 780,000 square foot office. It was acquired in 2014 for almost $500 million. The property was almost 100% occupied at that time. The landlord lost Bank of America a couple of years ago. B of A had occupied 75% of the space, and the building is now 31% occupied. So we'll be watching this one very carefully. If and when this comes up for sale, this will be an important benchmark for the FIDI Manhattan area. A loss like that and a new benchmark of $250 a square foot would be quite sobering for that part of the market. Turning our attention to some green shoots. I love this one. This one came out of left field for me. Station Place 3 is a property we've been following since 2018 in our 6:30 a.m. TreppWire release. If you get our morning research, you'll know the story behind this. That year, Congress voted to allow the SEC to search for new headquarters. The SEC occupied Station Place 1, 2, and 3, which I believe is by Union Station in Washington, D.C. There were lawsuits involved. The landlords who had the SEC tried to keep the SEC in place. Things lingered for a long time. But the bottom line was the SEC decided to stay in Station Place 1 and 2, but they gave back space in Station Place 3. They had an enormous amount of space in that property. The property had been, in our estimation, kind of dead loan walking. In fact, the loan was huge. It was $190 million, and it was going to have a 40 or 50% vacancy rate now that the SEC was gone. And out of left field this week, healthcare firm Kaiser Permanente came in and offered and paid $198 million for the property, which should make this loan pay off in full. The loan backs 4 big 2017 CMBS loan pieces. And this is what you call, just getting a gift horse. We thought that this was going to go into special servicing, maybe be foreclosed upon, value dropped. Kaiser Permanente, which we didn't know, had an option to buy the property. They exercised that option. They already had 20% of the space in the building. Now they own it all. So what a great story going to Thanksgiving for owners of 4 CMBS deals.
Yeah, I think that is a great story. I mean, that's one of those things where when everything looks bad, there's a silver lining there. Kaiser was sitting on that option to be able to purchase the property. Some of the negative headlines and some of the negative perception of those loans probably worked in their favor, so they were able to scoop it up. But for the bondholders, it's still going to make them whole. I wanted to point out on a couple of the other stories that you ran through, Manus. I went back and looked through these. The Midland portfolio, that was a 2019 office deal. The Colorado office was a 2020 office deal. Reston East Point 2017 deal. The Preston Road in Dallas 2017 deal. So there's some, I guess, just some synergy there in the sense that these were office deals that were, issued all around the same time period, where there was clearly some pretty strong thesis of value attainment in those properties. It's kind of interesting when you look at it just 4 or 5 years later, how the dynamics of the market fundamentals have shifted so significantly.
I think you're really onto something there. And I'm glad you brought up the point about this being 19 and 20, that what we saw in the mall space was the malls didn't run into trouble until they reached their maturity date. And that's when you found the default, that even if the mall was marginally come out of pocket to keep the loan current, the owner of the property was looking at this as a risk-free option until the balloon date. And as we know, even at the balloon date, a lot of them leaned in, a lot of these owners, and kept these properties. What we might be at the cusp of, based on your observation, is that these office owners are not waiting till that balloon date. They're saying, we can already see the handwriting on the wall. We know this tenant is not going to renew. The renewal date is 6 months hence. We're not even at the point where we're going into our pocket yet, but we're ready to pull the trigger and go down the foreclosure option now. If that's really where we are, then the people who have been ringing the bell that office is much worse than we have been giving off on this podcast, they might be right.
Yeah, I think that's potentially what we're going to see play out now is people are going to say, I'm going to stop throwing good money after bad. At a minimum, we've seen even with RXR and some of the larger players, they were very proactive in saying they're giving the keys back. And what we've seen is modifications, extensions, and other things that are favorable for them. So I think for these smaller offices that maybe don't have such the cachet, to your point, there's really not an impetus for them to keep them. They're not, why wait till maturity and try to work something out there or walk away? I think they're testing the waters now. And if this proves successful, where there's either extensions, modifications, some other type of redo of some of the term, then you might see more people checking this route as an option. If it goes actually through the process, to your point, that kind of begets like a downward spiral that people have been talking about that we haven't really seen outside of San Fran.
We would be well served to bring the Henley Group back on the podcast. We had them on early in the days of the pandemic. Our conversation really had to do with retail. It was how to get that forbearance in place when you were not operating a store or a hotel, and you could unleash FF&E reserves and so forth. We have to get them back on and talk about what they're seeing in the office space. A couple of other green shoots I'll run through quickly. In Denver, love reporting this, B of A Technology has renewed a big lease in Denver. The property is a 140K office on Ringsby Street, or Ringsby Court in Denver. That property is part of the taxi development, kind of a hip, high-tech part of Denver. B of A Technology is the top tenant there with 64% of the space on a lease that was to end in 2025. The renewal runs for another 10 years, so they'll be in that taxi development until 2035. That particular property backs a $31 million CMBS loan. And in New York City, Brookfield has gotten Spanish bank BBVA to take 75,000 square feet at 2 Manhattan West. 2 Manhattan West is in the Hudson Yards neighborhood. The good news here is not only will BBVA taking 74,000 square feet, it's that it's a substantial upsizing from, I believe, the 45,000 square feet they have currently at 1345 Avenue of the Americas. So a couple of good stories there in the office thing going into Thanksgiving.
So Lonnie, around this time last year, you wrote an analysis that really looked at the perspectives in CRE and what it meant around distress. In October 2022, you put out a report that said there is $52 billion worth of loans comprised of just over 3,000 properties that mature over the next 24 months and have a current debt service coverage ratio of 1.25x or less. Can you talk to us about what you're seeing in the data now and what that means?
Yeah, so it's really interesting timing here because that article or blog that I wrote got a lot of traction on social media. It's actually how we met our friend Danielle DiMartino Booth and eventually had her on the podcast, and caught a lot of other people's attention because the 54 billion kind of jumped off the page as, you know, properties with near-term maturities, 24 months or less, DSCR at 125 or less. So it's kind of fallen off the headline. You know, we've had so much other stuff with interest rates and everything else just really taking the narrative, and office obviously controlling a lot of the narrative. So today I went back in and reran that same search in our data, and I was really shocked when I saw the numbers. So let me just kind of work through this with you. And we'll post some follow-ups after the podcast on Twitter with some screenshots and some other things so you can follow along a little bit easier. But you had mentioned just over 3,000 properties in the previous analysis. In this instance, it's almost 7,600 properties that meet that same criteria today. So 24 months or less on the loan term, 125 or less on DSCR. So 7,600 roughly total properties, almost 117 billion in near-term loan balance outstanding. And a couple of interesting takeaways. Multifamily, not surprising, leads the way. But multifamily has almost 3,100 properties. It's about 55 billion worth of near-term maturity with debt service less than 125. The one that really surprised me was industrial. There's about 2,600 industrial properties, about 21.1 billion in outstanding loan balance that have current DSCR less than 125 and less than 24 months on the loan term. Offices there about 15 billion. Lodging is about 11.5 billion. So I don't know, Manus, what your thoughts are. The industrial is concentrated in one of the non-publicly traded REITs. So we've heard a lot and talked a lot about BREIT and some of the others. I understand they're having some redemption challenges. The properties probably in this case on the industrial side are not performing what they had underwritten, but that 21.1 billion comprised of about 2,600 properties really goes against the narrative that we've had for the last several years.
Well, I think a lot of it comes back to that whole cap issue we've talked about at various points all along. I'm not 100% on solid footing here, but I do think that a lot of the industrial portfolio debt was done floating rate with extension options. I think that the profit has been squeezed out, whereas they once had a 3.5x DSCR, maybe it's down to 1.25x DSCR because of the higher debt service costs. Their maturity date is coming up, and if they want to extend the loan, they're going to have to buy another very expensive cap. So I don't think our narrative is wrong. I think the narrative is right that industrial is still in high demand, still getting great bids on the acquisition side, and still getting premium rents on the tenant side. But I do think the financial engineering that went on to arranging these pools of loans is an Achilles heel in the industrial space. It might even be a bigger Achilles heel as a percentage of the entire industrial market than it is for other property types. There might be more industrial floating rate loans as a percentage of the market than it is for other property types. You know, that might be the case. But there is one aside that we should mention as you bring this up, and that is that if this is the canary in the coal mine, I don't know, but there was a headline this week that Amazon was going to start making their properties available for sublease. So that would be a double whammy, right? Being hit by higher interest rates and caps and now seeing peak demand kind of being reached, that would be problematic.
Your thesis was right on, Manus, on the floating rate on that one large portfolio that I was mentioning. I don't know, we're both sitting down so we can absorb this interest rate shock. And they probably have a cap in place. I haven't done the due diligence to dig in deep to it, but on those deals, the loan rate in some instances is over 11%. If they don't have a cap, or if it expires upon extension, there's some of these that are 13%. A bunch of them in 10 spot, some at the 8.5 to 9.5%. So yeah, if they went into those deals at sub 3 or 3, 3.25, and now they're at 10, 11, 12, 13%, that definitely impairs debt service coverage and performance.
I mean, one of the fallouts from this, and maybe you'll agree, maybe not, but I would think if I'm owning one of these portfolios, we have extraordinary value right now. Industrial not down very much. Even though cap rates have gone up considerably. I think in the industrial space, I think we're talking maybe somewhere between 5 to 10% below peak value even now, even though cap rates are up 3 or 4 percentage points over the last 18 months. I would not be shocked if some of these big portfolio holders just start trying to sell this stuff off just to get out of this debt, right? A lot of this stuff can be prepaid freely without any kind of yield maintenance or prepayment premium. If you're an industrial buyer out there, somebody who's been looking to get into the market in bigger volume, maybe it's that time to call the Blackstones and the Brookfields in the market and see what they're selling. Any reduction in their portfolio would bring down the amount of their outstanding debt. It would erase some of their redemption issues, and it might be an opportunity for buyers looking to get into that market.
Yeah, I agree 100%. And these are kind of under the radar in the sense that they're still current and performing. They're past their original loan maturity date in some instances, but they have extensions. And to your point, with the redemption pressure that they're feeling, these are probably some scalable opportunities for the right buyer to come in. And if you look at certain markets with a lot of the spec new construction coming online on the industrial space, there has been a little bit of a pullback in leasing velocity. So, there might be some opportunity in industrial, which has been a little counter to what we've heard and seen in practice over the last year, because it's been so hot. Like, you've had to overpay to get in. Maybe you're starting to see a little bit of a leveling off with some of this data. And if you're interested in the data, you should reach out to us. We'll be happy to kind of walk you through the platform, show you the kind of information that we have in the tool and service. And there'll probably be some additional research reports, as we mentioned, that will be forthcoming based on this information.
Something else that the market was anticipating, but we saw this week, was the sale of the billions of dollars of Signature Bank loans backed by New York apartments.
Yes, this was heavily anticipated. This was broken, I think, an exclusive by the Wall Street Journal on Sunday night into Monday morning. We saw a lot of buzz on social media about this on Sunday night. The story went that two nonprofits and related fund management were poised to win an auction of loans that were previously held by Signature Bank. Signature Bank, everybody recalls, was seized a couple months ago. Some of their assets were taken over, but a lot of them went to the FDIC. The FDIC was in charge of auctioning these off. And the article said that the leading bid was less than 70 cents on the dollar for the portfolio of rent-regulated apartment loans in New York City. So two takeaways here. The glass half empty is, you're talking under 70 cents on the dollar. You're talking about really distressed asset prices, right? That's not the kind of number, even in this higher cap rate world, that you're expecting to see, right? If you were saying 80 cents on the dollar, 75, right? That's the glass half empty. If you're looking at the glass half full, this is probably one of the hardest hit parts of the market. This is rent control, New York City, out of favor assets, and is probably not representative of the broader national multifamily market. So if you were looking at this and saying, wow, distressed assets in multifamily are now going for 68 cents on the dollar, that's not this. This is rent controlled inventory. But even so, it's a big loss for the taxpayers.
Yeah, and this is, I think we had a section or a segment a couple of months ago where we were calling this toxic assets, kind of went into the definition of what that was, and based on market perception, based on people's inability to actually transact on these. So I think any transaction is probably good news, but to your point, 70 cents on the dollar is nothing to be super excited about. This requires an asterisk because of the reasons you mentioned. So It'll be interesting to see how New York plays this out. I mean, Bob Knackel mentioned it. We've had several other people on the pod that have talked through this. Like, if we're in the same position with same stringent restrictions and all of this stuff in 5, 10, 15 years, it really has the ability to potentially create just enormous downward pressure on that segment. To your point, potentially erode the tax base and other things. So it'll be interesting to see how this plays out. Hopefully it does some good for the community. Hopefully it provides some continuation of affordable living opportunities. But at the same time, I think it definitely identifies an area of potential risk broadly if these parameters continue to put pressure on the markets as they have.
I think I saw a headline this week. I didn't read the article, but a headline went scrolling past me that the mayor of Boston is thinking about implementing rent control. And I don't know, I need a megaphone out there to reach the Back Bay, but don't do it. Don't do it. This is a recipe for housing shortages, higher prices, lack of development. I can't echo it loudly enough. If this is the way Boston's going to go, you're setting yourself up for decades of disappointing headlines over housing availability and cost.
Yeah, I just don't understand where supply and demand economics, like, they evaporated from the marketplace at some point. So just build new inventory, prices come down. It's pretty straightforward in most instances.
So this week, Manus, you were reflecting on Thanksgiving and past traditions and also the market in general. So you actually mapped out some reasons to give thanks to the CRE market, even in what we're calling a down year.
Thank you, Haley. The impetus for this, Haley mentioned this and Lonnie mentioned this last week, that we've started a new morning commercial real estate rundown. We noted last week that there's just not nearly enough time in the 1-hour podcast we do each week to cover all the things we're seeing. So we started about 10 days ago putting out a rundown every morning at 7:30 that's available to our clients that really encompasses everything that we've seen in the previous 24 hours. So this week we talked about things like the signature loan portfolio sale, other big deals we saw coming out of remittances, some new financings we saw. So if you are a client and you haven't opted in for this, reach out to Haley and she will make sure that you get access to this. But I wrote one for this morning and it was really channeling John Madden. And for football fans, there was no Thanksgiving without knowing and watching John Madden. And he would do the calling of the game with Pat Summerall on Fox, and he'd be in either Dallas or Detroit. And at the end of the game, he would give away a turkey with 8 huge turkey legs that would be given to the players of the game on the winning team. And he'd always chuckle. What turkey has 8 legs? He'd have, his own line like, a turkey has 4 legs or 2 legs. How do we have 8 legs on this turkey? But it just made me, when I wrote up the Tuesday morning thing, I wanted to give out 8 legs for people in the commercial real estate market that I was thankful for this year. And I'll run through them very quickly so that people can start their holiday listening to Arlo Guthrie and Alice's Restaurant, not our pod. So, all right, things that I was thankful for this year. Turkey leg number 1 goes to banks that kept lending after the failure of Silicon Valley Bank and concerns over deposit runs. Banks pulled back to the detriment of CRE, and our first turkey leg goes to the banks that stayed open and kept the capital flowing. Turkey leg number 2 and 3, they go to mall owners that kept fighting the good fight. Number 2, and buyers that came to the table to assume loans that had considerable negative equity. We saw a few of those this year. They get leg number 3. Leg number 4 goes to people like Dan Gilbert in Detroit, people that look at what a city has become and don't ask why, to channel Robert Kennedy, but look at a city and say, what can it be? Dan Gilbert has done that in Detroit, and I want to applaud him and other people who have taken chances in places like Baltimore and San Francisco to reverse the tide of decay and falling values and have put their money where their mouth is to come to the table. So legs 4 for Dan Gilbert, and leg 5 for the rest of the people that have come to the table with money to put to work in distressed areas. And legs 6, 7, and 8 this year go to office leasing brokers, loan originators, and sales brokers. There were no popping of corks for leasing brokers, originators, or sellers this year. The market was extremely challenging, high interest rates, a drop off in sales. Legs 6, 7, and 8 go to those who kept persevering throughout a tough year. And we hope that next year may not be turkey legs, but filet mignon for you. That's what I got.
Yeah, that was really great, Manus. And I think John Madden refer to this as the turducken or something like that. I think he had a name for it, but I think that's spot on with reasons to be thankful for the CRE market. It's a deal maker industry. People are built tough. They persevere. They make the calls. They do what they got to do. It's incredibly great when the market's strong and sales are plentiful and everyone makes a lot of money, and it's really tough when things slow down. But we've just seen through the people outreach with our podcast, even folks that are down this year, transaction wise, they're still optimistic, they're still persevering, and I think it's a great message. So I appreciate you sharing that.
And it's pretty funny. We keep saying this week in the podcast, but it really is only Tuesday. So there hasn't been much of a week, but even in a shortened week, we've gotten a lot of shout outs from you all. So I'll run through those quickly. We mentioned our upcoming Trepp webinar that's happening on November 28th and had a bunch of people reach out about that. So if you didn't get that registration link, send an email to podcast@trepp.com and we'll send it to you. So thanks, Brian P., for being interested in that webinar. Brandon D. let us know it's his first time reaching out, but he's been listening for about a year now. Gershon A. is a longtime listener. We got an email from Mark T., who said he loves our show. He thanks us for doing it. He was interested in our sale index that we talked about last week as well. Andy B. said he was surprised that Manus didn't take the opportunity to make a Transformers pun with the jeweler building in Chicago on last week's podcast. And then he said maybe a pill could help with that. So you'll have to listen to last week's episode if you have no idea what we're talking about.
I've only seen one of the Transformers movies, so I have to go back and look. It's funny, when I do watch a movie now, it's always, I'm looking at the character second, I'm looking at the background first. I'm looking at what buildings are in there, where it's taking place. Is it Madison Avenue? Is it Fifth Avenue? Is it San Francisco Bayfront? Where are we looking at? Is it Lombard Street in San Francisco? So being in the CRE business certainly changes the way you look at things.
Yeah, I think Elf and several of the other holiday movies, it's interesting to see, especially in relation to where those buildings are to our office there in New York. And, maybe if they wanted to film some more stuff in Chicago right now, they could probably get some pretty good pricing on renting out whole buildings that are empty.
Yeah, speaking of that, we typically do a fun holiday blog that talks about here are the famous CRE buildings in the back of your favorite holiday movies. And we also do one that maps out the Macy's Thanksgiving Day Parade route and all of the buildings that are in CMBS. So you can check out those on our Trepp Talk blog as well. And we mentioned a lot of plugs from last week's podcast and Ambrosia, but we had a few people that loved your comments on that, Manus, or maybe they didn't. But DS or Misty S said, "Hey, Manus, you're not alone. Ambrosia is delicious, and he loves the podcast, so thank you." And Michael from LinkedIn reached out, and he actually sent some recipes for a Jell-O recipe as well. So we'll have to look into that one.
Well, my wife said I have to correct the record. I said that it's made with mayo, and she said, absolutely hell no. It is sour cream. She said mayo would be disgusting, and she wanted me to correct the record on that. So there you go. I had a couple of shout outs. Coldwell Banker, I spoke to their 500 commercial real estate brokers last week. I had a lot reach out to me on LinkedIn. Thank you for all of that. I did have a couple people come back to me saying that they were also at the Dave Matthews concert in Greenville, South Carolina. I have a couple of coffees to set up when I'm back in South Carolina.
Those are great shout outs, Manus. And I know you do a lot of that those speaking engagements with people in the industry. And it's really great for CB to invite you there and for us to be able to share the information that we have. And I was thinking, I know you love music and you're a music fan, and you just talked about the Dave Matthews concert. After the last 2 weeks podcast episodes, I think if you ever were in a rock band, it'd have to be named Ambrosia at this point.
There is an Ambrosia, isn't there? From the 70s. You can look it up. They're in yacht rock.
There you go.
Yacht Rock character. You have to look them up. I think they had 2 or 3 hits. I remember in the 70s, the few times my dad let me put on AM radio before AM radio flipped over to FM radio and all the music went over there. You'd hear Ambrosia like in 1976. I have to look it up. I'm pretty sure
I
that
see
there
it.
is one.
5 top 40 hits.
Holy
Wow.
smokes.
There
Well,
you
this is
go.
what happens when you have people born in the 80s and Haley probably in the 90s or 2000s. We don't know about this. I know Steve Miller Band. Like my dad used to rock the Steve Miller Band. I know that.
He's a Dallas guy.
Yeah. So that's unfortunately, so that name's taken. So we're going to figure something else out, but still fitting.
And a few more before we close. Cameron B is a CRE appraiser based out of Denver who's a big fan. And thank you to Shyla L and Paul M. And then a fun one from this week, we wanted to give a shout out to the team at FinTech TV. That is a live show that films at the New York Stock Exchange right there on the trading floor. They invited someone from the Trepp team out there to join their show this week. So we had our own Stephen Bushbaum head down to the New York Stock Exchange and we got to meet with Kit T and Kat T and Vincent M. So thank you guys for having us. We got to be on the show and talk about our CRE data, and that segment of the show will be live later this week. So we'll share it on our social media channels if you're interested in checking that out.
And I have 1 more or 2 more. Joel and Dave, thank you for the golf invite down in Georgia. It was another great day. I had far too many shots that day, but it was great company, great talking CRE, and it was a lovely course. Thank you for having me.
And we want to wish all of our listeners a happy Thanksgiving. Thanks for listening. And we're very thankful for all of you guys for taking time out of your week every week to make time for us. So we appreciate you. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.